And truth be told, in this 1 year run of a massively changing marketplace, I have never seen such a series of market indicators sincerely pointing that we are going to have trouble comparable or possibly worse than the great financial collapse in 2008 within the housing market sector specifically. And the unfortunate thing is that a massive amount of those leading indicators that this repeat is about to happen are lighting up all over Florida over and above the rest of the US.
Record high mortgage levels are starting to take their toll. The mortgage rate is at 14.75%.
Ask not what the Great Reset can do for you. Ask what you can do for the Great Reset.
Folks, welcome back to the channel. The breaking news this week is that there's a massive amount of inventory piling up on the market throughout the country. Now, the greater story has been that since the beginning of this year, buyers have gotten further and further away, and ultimately inventory has climbed 15% over prior year. But what's dramatically underreported is that everybody, while they're focused on the buyer and how the buyer can't reach the American dream and how unaffordable it is for the buyer to actually get into the game, and that's what's ultimately been holding back the market, folks. You got to understand that the stories that are stacking are now saying the same pressure that the buyer is facing, the seller is facing. In a sense, you have an economy where neither party can hold on to the asset, folks, and that is going to get very interesting for 2024, because just in the most recent 30 straight days, there's been record number of price cuts US-wide. There's been a massive drop in homes going and pending all over the country. Americans are maxing their credit cards out. The same thing that crashed the marketplace in 2008, the fingerprints of which are now all over this housing economy once again. But folks, on top of all this is the insane statistic that sellers are dumping inventory into the housing market at record numbers for November. So folks, listen, it's unseasonably high, meaning this is a time where sellers say, this is a frustrating process. I don't want people walking through my house seeing my Christmas tree. I've got guests coming over last week and they're coming over next week. Everybody vaporizes their home off the market this time. Going back in history, this is going to be one of the most active Novembers of sellers getting out. And when you see unseasonable changes, that means that sellers across this country have absolutely no other choice than to put their house in the market. And it's on the back of story after story that buyers are resisting the marketplace as it is. Even before all this inventory dumped on the market, buyers said, time out, I'm gone, I'm not buying your house. And we have all this inventory coming, folks. And folks, you got to understand, as we turn into 2024, the spring market is also coming. So there's going to be a dump load of more inventory on top of that. Combined with all the builder exuberance that took place all through the summer, many of these builders spiked building permits, which many of them are building droves of houses to bring into the market on top of all these desperate sellers. And folks, who will win in a situation where there are no buyers? You have a desperate home seller who cannot afford to hold on to their house anymore, and you have a corporate builder who will reduce prices by 100 grand or more if they have to make sure they don't hold on to that house longer than they need to. Folks, I did a ton of research. I got great data to show you about the most challenged parts, particularly in the Florida market, but in the US at large. But as we smash through the data, please smash the like button so that other buyers and sellers have an opportunity to see this information. And continue subscribing if you like all things real estate. But let's get into the update. Is 2024 shaking up to be the next GFC? Well, let's get into the supply side of the news. So we had September and October were two of the deadest months, 13-year lows. According to CNBC, home sales fell to a 13-year low, slowest pace since August of 2010. What was it like in August 2010? It was terrible. You had sellers that wanted to sell, but no buyers. Now, in this case, you have no buyer affordability, buyers can't get in, and you have sellers growing. Now, look at this. Prospective buyers, further down the article, according to Lawrence Yun, prospective home buyers experienced another difficult month of persistent lack of inventory and the highest mortgage rates in a generation. However, there were still some multiple offers. This, according to Lawrence Yun, chief economist for the National Association of Realtors. But look at this, next story over on the left. Record level of price reductions. If inventory is a problem, how come all this price cutting? How come they're not selling? How come they're not all being absorbed with multiple offers? Look at this, according to Redfin, this is the past month. Housing market update, record share of price drops. And I think that this is the highest share in 2 decades. Now, mind you, this says nearly 7% of for sale homes posted. So what this means is that people that came into the market in October bumped their price down nearly immediately. Big jumps. There's people reporting throughout the country sending me notes. Hey, look, this house is down 50 grand, 100 grand, and it's only been on the market for 2 weeks. So you have major price adjustments going on early. Now, what this means, it says 7% of for sale homes post price drops. That means, according to Redfin, the way they track, it's not all the homes selling. You got to remember, like, of all the homes selling, like 30% of all the homes are getting price reduced right now. But in the first month, a bigger percentage, one of the biggest percentage ever, because sellers are hitting the market and nothing is happening. Look at this, record high cancellations last month. So home sales fall through at the highest pace on record. Head scratcher. I don't know. I've been in the real estate market for 20 years, sold thousands of homes. You know, one thing I never notice when there's not enough inventory? When there's not enough inventory, buyers grab onto homes and they don't let them go. This right here is a sign that people are dropping houses because they're too expensive. They don't like the price. They're having buyer shock. They go and figure out what taxes actually cost and insurance and all these other things. And they realize that they just can't make it. Now, you stack all of these odds in the marketplace with the supply. And then what comes next? Well, enter the story narrative now, which is we have unseasonal inventory surge, particularly in Florida. Florida's setting the national narrative on this. And on the other side, we're going to have increased supply because builders are about to load the cannon and shoot a ton of supply on top of these sellers that need to sell their home. Now, look at Redfin. This week they released, where are the listings pumping into the market from? These are the newest ones coming in on top of sluggish markets. San Jose, California, surprise, that was one of the headliners for the GFC last time. Phoenix, surprise, so were they. And then, of course, West Palm Beach and Orlando. West Palm Beach, by the way, caught my eye because West Palm Beach, that's in the metropolitan statistical area for Miami, by the way. And that has almost been bulletproof, ironclad, impossible to tip over. But folks, times are changing. Look at this. This is according to Altos Research. This is where tons of new listings hit the marketplace. Look how many of these folks, Florida, Arizona. So you have multiple markets that had inventory dump that were problematic in the last crash. So let's take a look. Where were the GFC losers last time? Okay, Florida as a state lost 50% of its home's value across the board. Good old Nevada, California, Arizona. These were the top four. So these are the very few across this entire US that saw a plus 40% massive hit. As you look across these states, you're going to come to realize that these are the same offenders that, by the way, ended up having issues now. Folks, take a look at this. This is the actual top 20 counties. These are where all the value lost. Now, you can see this first metric right here, this first column. The counties lost this much in the last GFC. This is from 07 to 2012. Price cave in. And you got Snohomish, Washington, which I think is Seattle, and Tacoma, or one of the two. Seminole, Florida, which is Orlando market. Sarasota below Tampa. Santa Clara, Santa Barbara, San Joaquin, San Diego, all the sands over there in California. Sacramento, Riverside. So you got California, which lost a ton of value. The entire U.S. market year over year is up 3 to 4% in price. Look how bad these are underperforming. So not only are they getting flooded with inventory right now, but they're flat. You know, they're 3 to 400% below US average on their year over year price points, which means they're already scalping. Look, negative 0.3, negative 3.4. This is Sacramento, California is trading 6 points off of the norm. San Diego's doing okay, but you got a bunch more that are just not clipping. Look at this. The top GFCs, top 10. Good old Detroit, Michigan lost almost 70% of their home value. Now, folks, Detroit and some of these other counties, I think it's going to be the last to turn because they're still probably, they're marginally cheaper than a lot of other metro areas. But look at this. Look at all these counties where Florida's on the list. Volusia, which is north side of Orlando. You're going to hear more about Volusia today. St. Lucie, Florida. St. John's, which is Jacksonville. And then a few other California counties. Now look at this. These are the top 10 biggest losers in the great financial collapse last time. Now, folks, this is going to be fascinating because you're going to see the same fingerprints of 60 some odd counties in Florida. You're going to see the same series of counties in trouble again right now. So look at this map. You have Cape Coral lost 57%. They were the highest loser in the entire state, which the state, as I mentioned, was 49%. They over-indexed the state's loss by 8%, and they're in trouble again, folks. Port St. Lucie, Orlando, Florida, Palm Bay, Deltona, Miami's way down number 6 on the list, and bulletproof, right? It'll never happen again. Sebastian, Florida, Ocala, Tampa, and so on. Look at this, folks. Let's stack the biggest gainers of year over year inventory versus the losers last time. Look at this. Number one on the list that lost the most inventory last time has the biggest leap in year over year inventory. Northport, Florida moved up the list. Now, Northport was number 10 when the last 07 to 12 collapsed. Now, folks, you got to understand that all these move and shake based on what happened recently in the market. How was impact? Now, Northport, Florida, I'm not an expert in that area. Candidly, I've never even visited, but what I do know is they experienced an explosion of growth during the remote worker relocation, the whole pandemic thing. Same thing. Naples was much more interesting. Now, look, I put number 13 because Naples was not far down the list. Naples lost a boatload of equity, and it was 13th county. And if this list on the right over here would have gone further down in the 40% range, you'd find Naples. And same with Sebring, okay? And obviously, a lot of these counties, you can see Deltona is fifth market to lose 52%. And right now, they're the fifth county in the state, back up, climbing that inventory ladder. Now, you can see again, Lakeland, Florida will be interesting to see. You can see it was 11 on the list of losers last time in terms of what its equity lost. And now it's number 9 on the equity list. And it was very popular, okay? But folks, look at this. This is what you need to understand. I'm going to show you some crazy things that are going to blow your mind. This is this year. You see this left side of the graph? This is the US-wide marketplace increasing. It's going up, yet buyers have backed out. They're nowhere to be found. You have the Lawrence Yunes of the world, even with this massive run up in inventory. And I say massive, it's 15%, folks. It's nearly straight up, okay? It's not straight up, but it's going that direction. But look over here, folks. Look at the dark red line. New listings are not up. This is not spiking inventory as a result of sellers putting their homes in the market. It's purely a function of buyers panicking and leaving the market. So what the heck is going on? So look at this. Buyers are out of the market and there's huge underreported issues. So there's issues in the economy that really kind of point to the fact that the buyer is screwed, but so is the seller, economically speaking, in terms of their ability to reach this American dream. And on the seller side, it's leaving their fingers. It's leaving their grasp. So number one, refinancing is up, okay? You got to understand this. A third of all application activity, as reported by the Mortgage Bankers Association, ongoing. It's 31, 32, 33. It's like a third of all the activity. Now, folks, if you go back to the summer of this year, go a few months ago, okay, different economy. People weren't as broke. They didn't borrow as much on their credit cards as they have now. Listen, it was like 24, 25%. It's higher now consistently. Now, not only is it higher now than in summer, when interest rates now are a percentage point higher. So if you bought a house and got a 30-year fixed back in May, 6.5%, 6.6, something like that. Would you refinance that rate to 7.5? Heck no. Same story for last year. So last year interest rates were 6.75, something like that. And now we're at 7.5% and you have refinance applications climbing. Folks, listen, the only thing this points to why anybody would get rid of a 2.95 rate, a 3, a 4, you only refinance for 2 reasons, folks. We all know what they are. It's rate and term, or it's to kick cash out of your house and turn that baby into an ATM. And the sad thing is, because of the nature of the history of rates going backwards, we know this only means one thing. This is only a Band-Aid for people who probably can't get a home equity line of credit, who are literally willing to go into a much higher payment on a 30-year term with interest rates higher than we've seen in 15 years, simply because they're financially hurting. The owners are hurting. So enter the second part of this, home equity lines of credit, which, by the way, everybody went in shock because in 2008, 2009, tons of people lost their houses over it. So this decreased for a decade. But now, folks, it's up 300%. People are searching for it more. They're applying for it more. They're closing for it. Why do people get home equity lines of credit? 2 reasons. They're in trouble financially or home improvement. If it was for home improvement, then explain to me why Home Depot's earnings are so far off. It's because they're not going to Home Depot. Next, folks, the cost of ownership is killing owners and it's killing landlords alike. Folks, just last Sunday, I did an update where I showed you a house, an actual case house owned by BlackRock. If you add all of the rent, because the rent is public record, we know what they charged. If you take 12 months of that rent, which was $36,000 on that particular example, and then you take the property taxes and you estimate insurance, you found that just the taxes, insurance, and HOA amounted to 50% of carrying costs, folks. You got Airbnb owners freaking out and having to sell. I just did an update. I released it on Thanksgiving a day ago. It was about 28,000 views. This was a huge update. I pull literal cases across Florida where builders sell a house to one guy for $900,000. They give the buyers and the buyer broker and the buying side of the transaction $150,000 in incentives that they didn't give the last person who bought into that neighborhood. Folks, new construction pricing has dropped 12% in a year. And that doesn't consider that by my estimation, most builders are putting between 6 and 8% in incentives on a lot of the inventory because they have tons of it and they can't keep it. So here again, if you did not see that video, go watch it. It is crazy eye-opening, and it's not just happening in Florida, it's happening throughout the country. And people are buying resale homes near the builder and paying way more because they don't know exactly how much money the builder is pulling out of the price. But folks, it's a crazy, crazy time. And the biggest thing that I want to impart on you is that every market is different. Every market is unique. It's facing its own headwinds. And whether you are a buyer or a seller, it's super important to know what you're up against. Like I always say, it's like a boxing match. Protect yourself at all times. Sellers, educate yourself if you're putting your house in the market in this economy. If you start off on the wrong foot, you're going to sit for a really, really long time in a lot of the markets, especially if you're well over the low to mid-range price points. But let's continue the conversation in the comments. Number one, what are you seeing in your area? Number two, what do you predict for 2024? As I mentioned earlier, it'd mean a ton to me if you'd smash that like button and subscribe to the channel for all things real estate. We'll see you on the next one.